Today we're going to drill down into VFVA, which is the Vanguard US Value Factor ETF. This is one of 5 new factor ETFs from Vanguard that are actively managed. This is not your grandfather's Vanguard fund here. This is a more souped up, pure exposure that has a lot more active management going on. A couple things here. First, it's going to track value stocks. In this case, there's ones for momentum and quality and such. Also, it's actively managed. That's kind of unique, but it's only actively managed to keep it on top of the factor. But it does have Vanguard's signature low-cost expense ratio of 13 basis points, which is very cheap for an active ETF. Let's look at what it holds. What's interesting about the holdings is not one stock has over a 1% weighting. That is so unusual for Vanguard, especially their smart beta funds, which are typically market cap weighted. Basically, it takes the Russell 3000, divides it into 3 buckets. So you're going to get small, mid, and large. And what you get here is a lot of stocks with very almost like an equal weighting. But what really brings this out is when you compare it to VTV. VTV is basically the best-selling smart beta ETF out there. That's going to have a P of 24. This one's going to have a P of 17. This one's also going to have more volatility and a higher active share. 75% of this is not in the S&P, whereas VTV only 45%. So again, you're going to get it's like a little more hot sauce in these new Vanguard single factor ETFs.
All right, good stuff, Eric. Thanks for the primer. We want to bring back in John Ameriks from Vanguard. John, talk a little bit about how you decided on the specific process for this new value ETF, because there's clearly a lot of different ways to go. Why does it even need to be active?
Yeah, no, so a lot of things to talk about there, Scarlet. Even the way that you led in terms of the same as other things that are out there, we actually think we're quite a bit different than the other things that are out there in a couple of ways. One is the active side. You've mentioned that. We've tended to view everything that's in this so-called smart beta category as being intended to beat the market or add an exposure that differs from the market. That's active, and people need to think about it that way. You guys have probably noticed there's even a little research report floating around today out of Bernstein that talks about the extent to which there's been development in index funds. There's more indexes than there are funds. A lot of these things are active strategies. We like that as a way to think about it. We think that's the right way for investors to think about it. We also think there's just incredible advantages to actually implementing it that way. In these funds, as Eric mentioned, look, we're taking advantage of what we think is a value premium that could exist across the capitalization spectrum. And because we're structured it the way that we have, and we chose the methodology that we have, we can go after the value that exists in the smaller end of the market in a way that a lot of the funds that are really concerned about tracking error and liquidity just can't.
So, John, it's Eric here. I want to talk about the Vanguard Momentum ETF, which I still have struggled putting Vanguard Momentum into the same breath. But tell me, there's a lot of ways to calculate momentum. Just real quick, what's the calculation? How do you define momentum?
I mean, there are a variety of indicators that we use there. I mean, we're looking at price return is by far the most salient characteristic. There's a risk-adjusted aspect to that methodology that we include in there, all trying to get at this sense of just the idea that underreaction to price movements is what is going to drive and persist over the medium term.
You know, as we talk about all this, I can't help but wonder, Vanguard founder Jack Bogle, not a fan of ETFs, he's made that really clear, not a fan of smart beta, certainly not a fan of active investing. What on earth does he think about this new product, John? Have you heard from him? Have you talked to him?
Well, look, I haven't had a chance to sit down and talk to Jack. I mean, I see him from time to time on campus, and I will sit down. He's always been a bit skeptical of anything on the active side. Yes. I think rightfully so. You know, look, it's hard to beat markets. You have to pay a lot of attention to cost. But for us at Vanguard, it does come back to cost, and it comes back to delivering what investors expect. Look, we know there are some investors out there who understand the Bogle math, that it's hard for the average manager to beat that index fund, the zero-sum game, and the rest of that. But there are some folks that know that mathematics, would like to try to outperform or tilt their portfolios in a particular way that either diversifies them or goes after a phenomenon that they find attractive. Right. We want to be able to do that in a way that maintains that low cost and that efficiency. And I think the products that we have here do that. Like Jack, I'm not a fan of people day trading ETFs. We think these are great long-term vehicles for people to get these kinds of exposures, which we think we can more effectively deliver this way than we can in a broader index fund.
So real quickly, John, looking at you have one multi-factor ETF. The debate is always whether to factor time or to kind of try to put the factors together and make something out of it. Yours does the latter. What was the logic there? Isn't this possibly getting like oatmeal and you dilute the factors?
Well, look, we know there are a lot of investors out there. There are many who get into the weeds and will do the decomposition like you do, Eric, look at their portfolio and have a very targeted idea of what exposures they want, and they know which factor they want. There are also a lot of investors out there who like the framework. They like this idea of using the quantitative methods and the research methods to try to decide how to invest.
Right.
And they're more agnostic about which particular factor, and they don't have a view on what will work over time. And so we put something together that we think represents a reasonable way of combining things to get diversification and still get outperformance from these products.